Good morning, everyone, and thank you for joining us for our latest Actionable Ideas webinar. With us today, we have Sandip Bhagat, our Chief Investment Officer, who will be discussing what could be the beginning of a new economic cycle. Just a couple of housekeeping items before we begin. First, we'll be asking a few interactive poll questions. To respond, simply click on your answer directly on the slide when it appears. And as always, please put your questions in the Q&A box at the top right corner, and we'll get to as many of those as we can at the end of the presentation. With that, I will turn it over to you, Sandip. Sandip, it has been a crazy year. Have you even had a chance to catch your breath?
No, Teague, not quite yet. What a decade this year has been. So much has happened in the last several months. It is hard to digest it all. How many of us ever expected to see this in our lifetime, let alone in 2020? It all feels so surreal. But then again, what better time than at the beginning of a new year, take stock of where we stand and what lies ahead. So thanks again for joining us today. I'm personally delighted to be with all of you again. Let's get started with a quick look at the year that just went by, and perhaps not soon enough. 2020 will take its place in history as a year to forget, but it will always remain unforgettable. A global pandemic devastated the world's economic order. It inflicted indescribable human pain and suffering. Many lost their lives. Even more lost their livelihoods. And those who survived were shaken by their own awareness of their fragility, their vulnerability. But through all this, global markets have so far created the unlikely outcome of a sharp V-shaped recovery, a scenario that was so unlikely back in March. Here's our first look at one of many V-shaped charts. This is the S&P 500 index, which finished the year with a return of 18%. There was no shortage of milestones along the way. It looks here like something momentous was happening every other week. The gain from the March close alone is a staggering 70%. The Russell 2000 index rose by 20%. It bounced by over 100% from its low. The NASDAQ composite posted a strong gain of 45%. Now, if all of this sounds universally good, then that is not true. So here is a theme that we will keep coming back to. One of the hallmarks of V-shaped recovery is its uneven nature. The COVID recession has produced big winners and big losers. We see that here. Technology was perhaps the biggest winner. You can see it is up 44% at the top. Not surprisingly, airlines and also energy were among the big losers. They are shown right there at the bottom. Foreign stocks underperformed US stocks. You see that right here in the middle of this chart. Now, this remarkable rally has raised a lot of questions about stock valuation. Have prices moved too much, too quickly? So we make this the first of our poll questions. This is going to be interactive. So here we go. It's a simple question. Is the stock market overvalued? Not individual stocks, but the market as a whole. So think S&P 500. 4 choices here. Yes, it is in bubble territory. Yes, it is overvalued, but modestly so. No, it is fairly valued. No, it is undervalued. You can click on your answer right on your screen. As soon as you see the question is visible to you, you can go right ahead and click on the answer. And I'm going to wait a few seconds here so everybody has a chance to get organized, aligned, click on the answer. And then in just a couple of moments, we can all take a look at how you feel as a group about stock valuations. going to go tick off talk. It's getting to be enough time. So I'm going to click right now. And oh my goodness, we have one bearish audience. More than 90% of the group feels that the stock market is overvalued. About 60% of you think it's in that modestly overvalued category, and a good 1/3 think it is in bubble territory. Well, this is very interesting. Of course, we have our own opinion to share with you, but I'm going to defer the market outlook until we first form an economic outlook. So let's move from the stock market to the real economy. This takes us to more V-shaped chart. And what do we have here? So this is the Purchasing Managers Index. It tells us whether future business conditions are likely to improve or decline. So the PMI is a reliable gauge of economic activity. PMIs above 50 show an expansion. 50 or below indicates a contraction. In each chart, we show the manufacturing and the services PMI, and we do so in clockwise manner. For the US in the top left, Europe in the top right, and then China in bottom. And we see a similar pattern across the globe. Economic activity fell precipitously during the early COVID shutdown, and it has since rebounded sharply with the reopening. So no surprise in the trend here, but I dare say both the speed and the magnitude of the decline and the recovery, well, it's really nothing short of stunning. So these regional trends aggregate to give us a simple story for global economic growth. We show that on the next chart. This is global GDP, and you see that another V shape. Global GDP fell sharply in the first half of 2020, and it is now expected to recover back to 2019 levels in the second half of the year. The big takeaway from the chart here is that it seems like no permanent damage has been done to the global economy in the long run. So our economic outlook today depends critically on what happened to create these V-shaped charts and recovery. So give me a couple of minutes to quickly go revisit and actually calibrate the roller coaster that was 2020. So the coronavirus pandemic brought an unprecedented level of economic devastation. How bad was it? US GDP growth declined by a staggering 33% in the second quarter. Now, the subsequent recovery was also unprecedented because policy responses on two fronts were, I don't know, how do you call it, historic, shall we say? So first, on the economic front, central banks and government all over the world came together, and what did they do? They inject massive monetary and fiscal stimulus into global economy. Policy rates went to zero. Some even went negative. Central banks extended their balance sheets through aggressive bond purchases. And what about the medical front? Well, what can I say? Human ingenuity came to the fore as a successful vaccine was developed in record time. No vaccine has ever been developed in less than a year. Today, we have several that are effective enough for emergency use. Just one kind of nuanced observation: the timing of progress on these two fronts was impeccable. Economic policy responses at the outset were swift when medical research was just beginning, and then as medical innovation gathered speed, economic policy eased up, but never to the point of risking another slowdown. So these policy responses combined, and they produced this historic recovery. Third quarter GDP came in at an astounding 33%. Fourth quarter GDP is projected to be well over 8%. And so is the first quarter of 2021, especially after the last round of stimulus. Now, these are all very big growth numbers. I wonder how many of you find them overly optimistic. Well, given the tone that we said earlier, I wonder how you're going to react to our second poll question. This one is a really simple question. What is the risk of a double-dip recession in 2021? Triggered by the virus, inflation, whatever your worries are. Is it high? Is it medium? Is it low? Again, see the questions on your screen. Answer this one directly by clicking on your choice. I'm going to give you enough time, so I'm going to wait with the tick tock, and soon enough, we'll find out if your bearish views on the market extend to the real economy. And here we go. Ha! This is interesting. Most of you peg the odd double-dip recession as low. It's almost 2/3 of it. So for feeling bullish about the economy, or at least not bearish about the economy, you're still nonetheless worried about the economy. So what should we do? Here, let me just use this as background information. We'll now delve into our topics for today. So this takes me to our main discussion point to form our economic and market outlook. And here we go. So we start with the key tenet of our economic outlook. I promised you answers, and I'm going to give you one right away. We project that the coronavirus recession ended in the third quarter of 2020. History will label this COVID recession as the sharpest and yet the shortest recession ever. By extension, that recession is over. A new economic cycle is now underway. We believe there are a number of aspects about this new cycle that are both unusual and underappreciated. We highlight three such themes in greater detail. That's the focus of our presentation. What are these three themes? Unusual consumer strength, unusual massive stimulus, and unusual initial valuations, the ones that have so far troubled me. We take a closer look at the cycle, then develop our market outlook, and then we'll conclude with some portfolio positioning for this upcoming economic cycle. So we start with our first and biggest theme here, which is unusual consumer strength. And I'm going to build up to this a little bit of that. So the economic conditions, I'm going to assert the economic conditions of this COVID recession were quite different from the global financial crisis of 2008. So what did we see back then? The consumer was quite leveraged. All that leverage really came from one source, home mortgages. There was easy money then. There were loose underwriting standards. You had access to subprime loans. You had all the ingredients, which, not surprisingly, eventually led to a housing bubble. Now, as bubbles inevitably do, this one crashed mightily, and the fallout was devastating. So consumers, of course, defaulted on their loans. Home prices crashed. Banks suffered losses. Jobs were lost. Incomes fell. Savings declined. And if all that wasn't enough, after all that pain, the U.S. consumer had to endure another long and equally painful deleveraging cycle. Why do I say all this? Because surprisingly, none of these conditions hold true today. Every negative from 2008 is now a positive for the U.S. consumer in 2021. And most specifically, like we show here, the U.S. consumer took a benefit from strong income and savings and spending fundamentals, from strong balance sheets, and from a strong housing market. So let's see how and why these consumer dynamics are different this time around. So here's a bit of a digression. I wanted to tailor my comments, make them as timely as possible. And I went back and pulled out, I think, a relevant data point from last Friday's jobs report. So as goes the jobs market, so goes the U.S. consumer. We know that. So what do we show here? We show the rate at which permanent job losses have been piling up during this COVID recession compared to prior recession. So I want you to focus on the far left. I believe that is the purple line. And you can see that permanent job losses in 2020 were building up at an alarming rate. They have fallen far more rapidly than the other two recessions, 2001 and 2007. But something is going on here. They seem to have stabilized. They have even reversed for the first time in the December jobs. So an encouraging sign, positive data for consumer incomes. So as we mentioned earlier, the impact of the coronavirus recession has been felt unevenly across the economy. Let me just revisit that theme very quickly. The travel and entertainment sectors have been the most heavily affected, and technology the least. But what does this mean? You have a setting of big losers and big winners. When you make the two, the economic impact of the pandemic has become more muted. Think of this example. For jobs that were lost at a local restaurant, there were new ones created at an Amazon warehouse. And so the net result of this dichotomy is that both consumer incomes and consumer spending have made remarkably rapid recovery, which brings us to this chart. Another V shape, we're showing the recovery in consumer wages. This rebound is truly remarkable. You know why it's even more remarkable? This is based only on wages and salaries. It does not include stimulus check or unemployment benefit. This trajectory here has been driven mainly by the impact of business reopenings and the shift in the mix of jobs that I just talked about earlier. Let's take a look at spending. We're going to use retail sales as a proxy for consumer spendings. And this V-shaped recovery in retail sales is, oh my God, it's even more stunning. U.S. retail sales bounced back to pre-COVID level in just 5 months during this recession. It took 40 months for retail sales to recover to their prior peak in the 2008 recession. So clearly the rebound in wages, which we just saw on the last slide, that has helped this recovery in retail sales. But there is also an important shift underneath in the mix of spending that is at play here. I want to draw your attention to this. And let me move ahead to the next slide to show how the spending has changed. So on this chart, we show consumer spending, but we break it out into spending on goods and spending on experience. So prior to the COVID recession, consumers were spending more on experiences than they were on goods. But in a sharp reversal of that previous trend, consumers are now spending more on goods than they are on experiences. In fact, pretty symmetrically so. You can see here, spending on goods has gone up by as much, has gone up by 6%, as much as spending on experiences has declined. That is also 6%. Now, looks interesting, but it really isn't that big a surprise when you think about it. But this was a forced shift of thought. Why do I say that? Well, where do you get your experiences? You get them in travel and entertainment, and they were simply not available during the pandemic. So the more interesting question is, how long will this persist in a post-COVID world and economy. So consumer balance sheet, not the consumer income, spending, the income statement. I think consumer balance sheets reveal an even bigger surprise. So let me set this topic up. General observations before we look at more. Now, what happens during a recession? It's common to see the level of savings decline during a recession. This can happen even though savings rates go up. They actually do. People are nervous, so they save on unfortunate cases. Despite an increase in savings rate, the level of spending goes down. But this cycle is different. I do need the next. But this cycle is different. What did we see here? We saw that there was a big increase, not only in the savings rate, but also in the level of saving. So what should you expect when savings rates go up? Could that translate into an increase in the level of savings? I think so. So just, again, a little more background information. We know we had the CARES Act back in March and April that delivered a lot of fiscal stimulus. And as a result, the personal savings rate went from 7% to a staggering 33%. It has since come down, but it's still at 13%, pretty high. So one manifestation of the high savings rate should be a high level of cash on consumer balance sheets, which brings me to this chart, which is precisely what we're showing. With one caveat, we are showing cash balances for just the bottom 50% of households by wealth. Why did we apply this screen? For this reason. So look, low-income households have unfairly and asymmetrically affected through job losses during the COVID recession. So what has happened to their savings? Have their savings been depleted by the job losses? We show cash balances over time. And what we find here is, well, take a look at what happened to cash balance during prior recession. They declined in both 2001 and 2008. That's what you would expect. But during the COVID recession, far right, we see a big spike. Cash balances for this group has gone up by more than 25%. The big difference between these recessions is that the COVID recession saw a big fiscal stimulus that helped to replace lost income. So the savings rate is high. I mentioned it's at 13%. You can see cash balances are high, even for those who might have adversely affected. These are two bullish indicators. Why? Because they set the foundation. They can help promote future spending. So let me turn to another aspect of consumer balance sheets. We're going to look at the level of debt. Are debt levels going up? Are the costs of servicing debt going up? How leveraged is the consumer? We just want to strike a contrast to that last recession. So what are we showing here? This is credit card debt shown over time on this slide. Now, it's common for variable debt, such as consumer credit card debt, to go up during a recession. This increase in debt typically created to offset the loss of job-related income. And we saw that in 2008 towards the left of this chart. However, during the COVID recession, credit card debt actually went down, not up. But is this also such a big surprise? I don't think so, not really. Stay-at-home restrictions simply meant that there were few opportunities to spend. There are two other COVID-related trends that bode well for the consumer. We're going to segue to that. My initial observations are that historically low interest rates have significantly lowered the cost of servicing existing, and mortgage refinances have surged to a historic high. So let's go to debt servicing costs, see if low interest rates have indeed made a difference. I'm going to go to the next slide, but for convenience, I'm still keeping the chart on credit card debt. On this same slide, it's on the left. I just want to build up a total picture, big picture on debt. On the right here, we show something called the financial obligations ratio. This is to measure the burden of debt. What is the financial obligations ratio? It's a metric calculated, it's the ratio. All contractual payments to after-tax income. And here is another unusual aspect of this economic cycle. Financial obligations, the percent of disposable income, rose. It rose in 2001. If you look somewhere in the middle of the chart, you will see the upward trend. They also rose in the 2008 recession. But in the COVID recession, they have fallen dramatically. These levels are absolute all-time low. So what's going on here? We think this is in part to a big decline in interest rates, same debt level, slightly higher debt level, on which you're paying a low interest rate, means your interest payment is down. We are not oblivious to a nuance here. We recognize something unusual could be at play here. A number of people got forbearance relief. Mortgage payments, rent payments, probably a partial explanation, but nonetheless, it is still very notable about what is happening to the balance sheet, to the effect on debt in this last COVID recession compared to the previous one. How can I summarize this topic? Let's just say consumer balance sheets are unusually healthier in this new economic cycle than they have been historically. Our final observation on unusual consumer strength comes from home equity. And again, I'm going to begin this section with some general observations. So what did the pandemic do? It triggered health safety concerns, of course. It promoted a new trend, working from home. And the two of these combined they've created a boom in the housing market. Why? There is now a premium on space and safety. And this has led to a large exodus from congested urban cities to open suburban living. So home prices have gone up, but they've gone up for a reason. Urging demand, record low mortgages. And this is in sharp contrast to what happened in the last recession. In 2008, home prices collapsed. Homeowners' equity, which is shown on this chart, went down, not surprisingly. It was above 14 trillion. It fell below 10 trillion. In 2020, however, this did not happen. Homeowners' equity continued its upward trend and now stands at over 20 trillion. So the rise in home prices helps the consumer in a couple of different ways. First, you have a rise in home prices, you have a rise in stock. The two of these combine to create increased consumer net worth, which, by the way, is now at all-time highs. And then this brings about a strong wealth. So this is a little indirect, but there is a more tangible and direct effect of the impact of this chart here. Beyond the wealth effect that boosts consumer confidence and then therefore support spending, let's take a look at how consumers have been able to monetize this increase in homeowners' equity. See that on the next chart. still keeping the homeowner's equity on the left. Just for context, it relates to the chart on the right. That's our new chart. And what do I want to say about this? The homeowner's equity has gone up, and consumers have been able to find a way to cash out this home equity. But how do you do that? Well, you do that through home equity lines of credit. You do it through mortgage refinances. You do it through second mortgages. And you see that at the far right. What's going on? This home equity has been monetized. It has been extracted, has been pulled out for 2 years now. But the surprising part is that trend continued even through the most dramatic recession that we have ever seen. Now, if all this talk about rising home prices is making you worried about another housing bubble, what can we do here? Well, let me do something to quickly allay those concerns if they exist. And I'm doing it on the next chart by looking at the supply side of the housing market. So home prices were rising from 2005, 2008. In hindsight, you can attribute this more to speculation than to fundamentals, trade-offs. In the middle of this chart, on your screen here, see the big spike around 2005. By the way, the chart itself is showing housing supply. You can see building up to 2008, the supply of homes was going up as well as home price. That doesn't jive. And just compare it to where we are in 2021. Very different. Today, the inventory of single-family homes is at an all-time low. I reckon it looks like it's about 3 months of supply. So in this cycle, the rise in home prices is based on fundamental supply-demand factors. This is not excess speculation. Demand is surging, and the supply of homes is limited. So how do we conclude this topic? Rising home prices have increased consumer confidence. They've also generated incremental cash flow for consumers. We have 2 remaining topics, and I'm keeping an eye on time, so I really think I need to speed the timing of my presentation. Those 2 topics are unusual massive stimulus and then unusual valuations. So at the depth of the crisis, the Fed, the Congress, they had no option but to underwrite massive stimulus. They did that, unleashed a flood of liquidity, and that has helped us get back to business as usual. And how has that happened? Well, we have found enough time to develop vaccines. Our businesses have been able to reopen. Consumers have been able to continue spending because of that. But the sheer magnitude of this stimulus is unusual in a historic time. And I feel I have to share a couple of numbers to show you how truly monumental this is. So I'm going to talk about central banks first. So here in the US, we start Fed. We know they cut it to 0. That's the chart on the left. Chart on the right shows that they've embarked on significant bond purchase. When I say significant, what do I mean? How significant? Well, significant enough to be unprecedented. The Fed has increased its balance sheet by $3.3 trillion, from just above 4 to well above 7 trillion. Remarkably, at their current pace, they will end up at 10 trillion at the end of 2021. Is there a historical context for this? Yes. During the global financial crisis, Fed, of course, did the same thing. But back then, they increased their balance sheet by 4 trillion, but it took them 6 years to do that. All this stimulus from the Fed has caused money supply to go up by more than 25%. And This narrative is not unique to the US. We're seeing it worldwide. And we show that here in this chart. These are global central banks. I show four of them here. The US, Fed, Europe, Japan, and China. And collectively, these four central banks alone have increased their quantitative easing or bond purchases by more than 8 trillion. Now, we should talk about fiscal stimulus, right? Because that was part of the panacea, the remedy to the crisis. And so you have seen this chart from us before. We had to add an extra bar for the 900 billion stimulus recently. And what this does now is the US government, if you add all this up, has announced a total of 3.9 trillion in deficit spending so far. What does this mean on a relative basis? 3.9 trillion is a staggering 17% of 2019 gross domestic product of 21 trillion. Again, unprecedented. You say, Sandip, you keep focusing on the numbers. This is a big number, massive. This is unprecedented. What does this mean in simple English? So there are two takeaways I want to leave you with. The first one is the following. You had recessions before. In previous recessions, we've been able to fight them with either monetary policy or fiscal policy, but rarely with both, and never in this magnitude, right? You simply just don't see bipartisan support to support deficit spending of this magnitude. It is also happening globally. It's a global phenomenon. And don't forget, there is a third global stimulus at play, the medical stimulus from vaccine. So this has the potential to be powerful. The second observation I want to make is a little more nuanced. It's certainly more encouraging. We've seen this big recovery because of fiscal stimulus and the monetary stimulus. But work differently, but very nicely in hand. Fiscal stimulus makes an immediate impact. It goes to the system. It ripples through it. It creates a big multiplier effect. Monetary policy works differently. It's not immediate. Its effect is felt on a lag basis. But the good news is fiscal stimulus in the short term, monetary for the longer term. And what will happen, we suspect, is that these low interest rates and all the bond purchases will continue to boost growth for several quarters from this point on. So in tandem, we believe that all this massive stimulus has the potential to create upside surprises to consensus growth expectations. I'll leave it there. Go to my last topic. We said one of the most unusual aspects of this cycle is what can I call it? Call it an elevated level of PE multiples for stock as we begin the cycle. So our stock hopelessly valued, as many fear. You guys do, right? 90% of you feel that the market is overvalued. So this is now serious, because if this is the case, a new bull market is just not viable. Who are we kidding? You will see a crash in equity value. So that's going to derail any engine of growth you can think. PEs will collapse. So, of course, we have some insight. We also have some take. And let me frame the issue here with some basic data on the next slide. We actually delved into initial valuations. And on this chart, what are we showing? We're showing earnings growth. We knew earnings fell a lot in 2020 and the different periods. But what are the statistics? In 2020, the earnings decline is projected to be about 16%, and in 21, the rebound is 24%. 2%, and in 2022, the rebound 17%. These are big, wild fluctuations in earnings, and you suspect because earnings are a part of PE ratio, this volatility will also flow through into the PE ratios. And that is actually the case. Here are PE ratios over time. Draw your attention to the far right. These are PE ratios in 20, then 2021. Two, quite different because earnings are changing and PE ratios are declining. So we are already in 2021. So what is the market focused on? It's focused on 2021 earnings and beyond. Let me hone in on those two PE ratios. For 2021, the PE is above 22. For 2022, the PE is right around 99. Now, these valuations, confession, they appear high by historical standards. But we also believe a comparison of PE ratios to past averages only tells half the story. Those historic PE ratios were achieved in a very different interest rate regime. Today, short-term and long-term interest rates are historically low, and growth has remained stable for a relatively long time. So this combination of rate and growth have caused PE ratios to re-rate. And to crystallize this even more, I'm going to switch gears. I'm going to simultaneously look at stock and bond valuations. We think that is actually even more revealing in the first pass. Go back. So what are we showing here? We're comparing the earnings yields on, what is an earnings yield? It's simply the inverse of the ratio. And we're going to compare it to the 10-year bond yield over time, just so you can identify with the data. The earnings yield here is shown in blue. The bond yield is shown in green. The wider the spread, the earnings yield and the bond yield, the more attractive stocks are to bonds. So what do we see with bonds? We see them start at over 5%. They've declined steadily for 20 years, from above 5 to 1%. And because growth has been modest throughout, P ratios have been able to expand the decline in interest. So for that question about stock in bubble territory, remember a decent percentage of you were worried about. So what comparison can I make? We actually do have a period when stocks were in bubble territory. So let's make that comparison. Of course, I'm talking about the internet bubble from 20 years ago that's shown far left. And what do you see here? You actually see the blue line below the green line. In English, you see that the earnings yield on stocks back then was below the 10-year bond yield. Very different today. In 2021, at the far right, earnings yield on stock significantly higher than bond yield. So in this setting, stocks actually appear fairly valued, focus on the right side, or I might get booed for saying this, that perhaps even modestly undervalued to bonds, right? Not in general, but to bonds. So what do we think? We reckon stocks can remain at PE rate around 20 in a stable growth environment as long as the 10-year bond yield remains below 1.5%. And then boom, skeptics in the room said, hey, well, stocks are already at those levels. How can they go higher? They're already at 20, they're even above. And we feel that there is still room. We believe that the next phase of this bull market, future stock market gain, will have to come from future earnings growth. There will be no more multiple expansion. So that's not your driver. And based on everything we have said so far, we believe that economic and earnings growth has the potential to surprise on the upside. And just on this one simple thesis, that leads us to be bullish on the economy and on stock. So we've covered a lot of ground. I need to wrap this up. So let me quickly summarize both our economic and market outlook. And I'm going to move on this really quickly. The economic outlook first. We believe the COVID recession is over and that a new economic cycle is underway. We acknowledge there are many known unknowns about this, maybe even more unknown unknowns, but we feel those risks are modest and manageable. As a result, we assign a low probability to a double-dip recession anytime soon. In 2020, we were dealt an unprecedented economic shock, but we've been able to make this recovery because of unprecedented policy responses. This cycle, however, doesn't have the trapping of a conventional recovery. There are several unusual and underappreciated aspects. We listed 3 of them to summarize. What are they? The U.S. consumer is unusually strong, more so than is the case after a typical recession. The policy responses have come from 3 fronts: economic, monetary, fiscal, and medical. Let's not forget that. They have been unusually powerful. And valuations are not washed up, as you would see at the end of a recession. They are elevated, but we believe they are not fundamentally or fatally flawed. Future earnings growth can still power a new bull market going forward. So here is the summary, all on one single slide. Teague, if you need to come back to this, the Q&A section. Well, how about market outlook and key takeaways there? That's next. So here you go. Let me start with our most bold prediction. I hope the 90% of you in the audience are encouraged to hear us say, and this is a touch emphatic, maybe too emphatic for legal counsel, but it's a belief. We believe stocks are not anywhere close to bubble territory. We do see bubbles. There are bubbles in parts of the market. There is a big bubble in an asset. You might be surprised to hear us say that bubble is actually in the bond market. That has been hopelessly distorted by banks. So we believe stocks offer better value than bonds. Based on our thesis of a revival in growth, cyclical sectors and assets may perform well going forward. What do I mean by this? Maybe your value stocks, small cap stocks, economically sensitive sectors, financials, consumer discretionary may do well. You immediately say, but what happens to growth? They've been the big winners. Are they doomed to underperform it? And we would say no. We say no because high quality growth stocks will never go out of fashion in the long run. In fact, we believe they're the best investment, tax efficient and long-term compounding of wealth. We expect interest rates to rise gradually, no spikes along the way, slow, steady increase. As a result of this view, we selectively emphasize credit in bond portfolios. Then we would take a bet on duration and interest rates. And finally, alternatives investments, we believe, will play a big role in portfolio diversification. we are intrigued with one asset class here. We find real, direct real estate investments to be particularly attractive, both from a growth and an income. And so, Teague, at long last, I think I've done most of what I wanted to. Here is the final summary of the observations. Teague, I know you've been collecting questions along the way. Knowing you, here's probably what you've done. Pick out either the most interesting ones, perhaps even the most difficult. Try and trip me up. So let me hand it back to you, and perhaps we can start on the Q&A section.
Thanks, Sandip. It's a lot of very interesting information. You've given us a lot to think about. Before we jump into questions, just a reminder, we will have these slides available after the call. And if we don't get to your questions, please feel free to reach out to your client advisor or portfolio manager to follow up. So Sandip, let's jump right into it. We're getting a lot of questions around stimulus and debt. And with all the stimulus and debt being injected into the system, are you worried about inflation at all? I mean, how much more debt can the government issue? Is there a ceiling to that?
Yeah, so look, we're clearly in uncharted territory. I would be remiss and misguided to point to any historical precedent to tell you how it all played out in the face of such massive stimulus. And so I am actually going to lay out and contend that what happens to inflation will be the biggest driver of this new economic cycle. We are mindful of that. In fact, we are abundantly cautious and vigilant, keeping an eye on this. But the data so far gives us some hope and encouragement, especially in the near term. I said money supply has gone up. The velocity of money hasn't to such an extent. Globalization has taken a bit of a hit with cross-border travel restrictions, but in a world of vaccines that will open up, and globalization takes manufacturing to the lowest cost of production. That creates a disinflationary pressure. We are, I was going to say, on the cusp of a new economy. Heck, we are in the new economy, which is so dominated by tech, and the huge productivity gains we will see there will also put a lid on prices. We have talked in the past about just central bank policy, where commitment to very clear forward guidance automatically creates low inflation expectations. And when investors become anchored in that belief, they act in a manner that actually makes inflation harder to achieve. And if the fear was any move in inflation is going to cause rates to go up, and this whole theory that low rates are helping support high debt levels by reducing interest payments, that could go out the window. But the Fed has given us a roadmap, right? They said inflation undershot its target for a very long time, 1-2%, if we go too long. The new Fed policy says we'll target an average level of inflation. We won't pull the trigger as soon as it hits. We'll let it remain above 2% for a long time. In fact, just as long as it was above 2%. And so all of this is suggesting to us, and we have the data from the last expansion, we're still substantial QE. We did not see inflation. And so productivity gains, technology, globalization, forward guidance in terms of we think have a secular effect. And so at least in the near term, I'm pegging that to be about 2, 3, or 4 years, worth keeping an eye on, not realistically a big factor. What happens beyond? Look, I would be foolhardy to come out and just an incredibly strong view. What happens to inflation? What magnitude at what point in time? And I'm just not going to be able to do that.
So we're getting a lot of questions on the labor market and wages, and we've seen a bifurcation in the recovery in the labor market, right, where a lot of the gains have been at the high end and a lot of the pain is being felt at the low end. And as stimulus runs off for the low end, how do you expect that to impact the economy and overall U.S. economic growth?
So we have to get the timing right? There was always the risk that if the resurgence of the virus, if there were more shutdowns, the economy would stumble, we would fall off a fiscal cliff because, we had the big bazooka with the CARES Act, and there was really precious little along the way. And so that is a risk. But if we get the timing right, those jobs will come back in the meantime. And look what the stimulus did at the most painful moment, right? In the second quarter, this group, this cohort, and I mentioned they were unfairly and asymmetrically punished. Their job-related incomes disappeared, but the fiscal stimulus was so aggressive that many households in this group actually ended because of the enhanced unemployment benefit. They were more than able to replace their income. And so this really is the balancing act, right? We fell into a deep valley. We have every hope coming out of it. And the question is, how do you build this bridge to overcome the divide, expand, and get us to the other side? So far, the impact of job losses on incomes in aggregate or on spending hasn't been significant policy, and you can only hope. They have done it right so far. There's no reason to expect a misstep right when the end is getting close.
So we've got about 3 minutes left, so I'm gonna cram a couple questions into one here. I know it's cheating a little bit, but what are your biggest concerns? I mean, you have a pretty upbeat outlook here, and in that list of concerns, where would you place the debasement of the dollar, and where would you place rising rates, given everything that we've seen? And that'll be our final question.
Not fair. There were 5 questions rolled into one. So I don't have much time, so I'll speak very quickly. There has been no shortage of worries along the way. The markets have markedly climbed, one wall of worry after the other. A couple have already resolved. We had election uncertainty, we had Brexit. There is always the question mark on the virus. We have a resurgence of cases. Will there be logistical issues in distributing the vaccine? What does that do? We have new mutant strains, one from UK, South Africa, Japan. And my view on this is, hey, look, the big breakthrough has been made in developing the vaccine. All of these other issues pale in comparison. So don't believe that is a big issue. We have perennial issues, climate change, income inequality, I'm not going to elaborate on that. Those are such slow-moving factors that, in fact, will be felt for so many different years. The biggest worry is debt and the impact on interest rates and inflation. I spoke to that. In my mind, that is the biggest wild card, biggest uncertainty. When does inflation rear its ugly head? And for the moment, in terms of keeping me up at night, that comes the closest when I'm still able to sleep like a baby, because I do think it's a few years out. What were some of your other questions? I know there was dollar mixed in. So
yeah,
I think we have a handful of risks.
Yeah, within that risk, where would you place the debasement of the dollar, and where would you place rising rates in terms of all of that?
Yeah, so rising rates are related to what happens with inflation. The Fed has said no hike in rates till 2023, but that bet would be off the table if inflation does something unusual. So either an unexpected spike in inflation or an actual increase in the real rates would make rates go up. Don't see that as a high probability. So I think good for the next couple of years, so the outlook stays intact. And a lot of people have fretted that we have such high levels of debt. We just underwrote with the high of dollar. And a couple of really quick observations. We were not alone in running up budget and federal deficit. The whole world did that. So now suddenly the dollar currency are a relative theme. Everybody is in the same boat. I would also contend that when growth picks up, in a risk-on mentality, foreign stocks, emerging market stocks, and foreign currencies actually do better than the US dollar. That might put added pressure on it, but what keeps the floor to the dollar is our unarguable status as the world's reserve currency that makes a dollar and dollar-denominated asset in great demand. And one final quick thought, don't forget this low dollar, and it's already declined by 8 to 10%, will have some really useful, meaningful impact on earnings growth. A lot of US companies do business overseas. The currency translation will make their earnings go up, which actually adds to our bullish story, at least for the stock.
All right, thanks, Sandip. I think that's all the time we have for questions. I'll turn it back to you for any closing remarks.
Okay, so Teague, hey, listen, I'll wrap it up here on behalf of Teague, all of my other colleagues at Whittier. I thank you again for joining today. We hope you found these comments and insights to be useful. Please don't bother to contact anyone on your Whittier coverage team. If you have any further questions, if you email me directly, and I will answer them as quickly as I possibly can. So on that note, we just wish you a happy and healthy new year.